Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 31st. Can you believe it? The end of August. And welcome to this week's In the Know Trader show. On tap this week, in our trader education portion, the question is, how do you handle adversity? We'll briefly talk about that. And generally what I'm referring to is market adversity, but I'd say how you handle it in the market probably somewhat emulates how you handle it in life. In our market overview, we'll take a look at the Qs, the 10-year, and then an ETF that's pretty new, WFH, Work From Home. And that's what we're going to concentrate. The rest of the show will be on work from home names, and we'll get through as many of these as we can. This is not a list that has every work from home name. I just put a bunch together from a variety of lists and even some of the components in this ETF. And we'll take a look at how the market is viewing these work from home names. And if we can also gather any intelligence from how they're trading in the sense of, is the marketplace thinking that we will continue the work from home mode or not? So we'll see how these are doing. Before we get going, just a reminder, check out inthenowtrader.com. By the way, we are building a brand new website. It'll probably be done in about 2 months. And it'll have lots more things on it than in the past, and subscriber login and password, etc. But for the time being, check out inthenowtrader.com, and you can get information about the weekly ETF Tactical Trader Report that generally comes out Thursday nights, or the monthly 7-Eleven report, which actually will be coming out tonight because it is the end of the month, and we give you the new asset allocations for the following month, so you can get into them right on the open tomorrow morning. The 7-Eleven monthly report, the goal there is to outperform the S&P by being in no less than 5 or more than 7 of the 11 macro spider ETFs. And we finished our first year doing this on July 31st and outperformed by 2.61%, simply by being able to avoid some of the underperforming sectors. And you can find out more about that too at inthenowtrader.com. To email me, Rick at inthenowtrader.com. And thanks for all the emails we get about not only this show each week, but of course, things that we talk about in the Know Trader reports. All right, let's start off with the idea of, again, how do you handle adversity in the market? And adversity could be multiple ways, but generally it means that in one way or another, you're losing money and or just giving back profits from what you would have originally had. So either way you look at it, it's essentially a drawdown from peak performance, or it's just been, you get into a trade and it's just goes sour from the beginning. So how do you handle it? And as I said in the introduction, a lot of this, how you handle it, is probably how you handle the same type of adversity in life. And I always go back to the same thought process to answer this question. So I'm going to go to this slide here and kind of say, and think about this for yourself. When the metaphorical ship starts to sink, all right, so the ship starting to sink is a trade that just goes bad. It's a portfolio that goes bad. Or, again, take this in a bigger sense towards life, is when either a decision you made in life goes bad, or hopefully not, but if life in general goes bad, how do you handle it? How do you handle adversity? And I generally break this down into, there's 2 categories of people. There are hopers and there are doers. Hopers are the people who hope things change and turn around, as if they're magically going to do that on their own. And then there are doers, those who proactively get themselves out of the bad situation. And again, you can think about this in life. And let's concentrate, however, more on the market sense. You can hope that a trade that's going bad can turn around and go your way, or you can do something about it. And a lot of it depends upon your risk tolerance and what your original goal was. Let's assume you bought stock XYZ. When you bought it, was it intended to be a trade, or was it intended to be an investment? And in the sense of, if it's a trade, then you should have much tighter limitations on how much you're willing to let this trade go against you before you accept your loss. If it's an investment, normally you have a little wider parameter. So if you buy a stock at 50, it may not bother you if it goes to 48 because you think the stock is going to 80 over time. And the 4% drawdown is not enough to get you to get out of the trade. However, maybe it's at 8% or 10% or whatever your tolerance is. At some point, if it's not working, you need to decide. And you have to ask yourself, are you a hoper or a doer? A hoper gets into a stock at 50, and when it's trading 42, they're still hoping it comes back to, and at that point, they're generally hoping all it does is get back to where they got in so they can get out for no loss. Or are you a doer? Do you limit your losses at your intended place to limit your loss? Or when your mental stop gets hit, do you say, well, maybe it'll come back, and watch it fall another 5%? And then you start getting more into a situation that, again, you in your head, you start begging for this to just get back to where I got in so I can get out and not have to admit that I lost money. The doers are the ones who stick to their, in this example, sell stops. They decide that when they buy something, where and when the market trades to a certain level, they say, I'm wrong, not the right idea. If it's from a trading perspective, it means your timing was off. It might be the right idea, but not for this as a trade. Maybe in 6 months or a year and a half or in 5 years, it works out, but not now. So I ask the question, when a metaphorical ship starts to sink, how do you handle it? You do what? Do you enjoy the setting sun, where some people just sit back and let life kind of hit them the way it does and do nothing about what the situation is that's adverse? Do you pray, hoping that some larger, bigger being is going to fix things and change the world so that what you want to happen actually happens? Or choice C, do you jump? Meaning you take action and you jump off of the bad situation that you're in. In the sense of a trade, it means getting out of the trade and taking a loss. And hopefully, if you've done your analysis correctly, where you decide your sell stop is to a bad buy is a good place to actually get out, because getting yourself stopped out suggests, from the analysis you do, that that stock is still likely going to go lower. So if you buy a stock against a support level and you're playing for that support level to hold, if the support level doesn't hold, it's time to jump. It's not time to pray. It's not time to sit back and enjoy the beauty of the stock market. It's time to take action. And those who take action, the doers, almost always come out way ahead in life than those who are the hopers. So this is not being anti-religious, that there's some bigger being out there that controls your life. It's not about that. It's about you and free will. And if you take money and invest it in something, or, when I say invest in this case, or trade something, when the ship starts to sink, decide which one of these type players you want to be, the hoper or the doer, the one who sits back and just lets things be however they are, the one who prays in hopes that something bigger than they are is going to change things, or the one who jumps and takes action and says, okay, wrong trade, I lost a few percent, let's keep this loss small and run. Those are generally your choices. I leave it up to you to choose which one you want to do. Let's get to some charts. So as we get into our macro look on the market, here are the Qs, the QQQ. This is the NDX, the NASDAQ 100 tracking ETF on all-time highs. This is a weekly chart. You see this has generally climbed up the clouds conversion line, which is the kind of magenta colored line here. The few times we broke underneath, we halted right at the baseline, and we're up on all-time highs. We've just passed just a little bit the 375.5 level, which was a propulsion full exhaustion level from the well, we'll call it the late winter decline. And now we're possibly, and my target for this move has been between 375 and basically 399. And you can see that that would be the next target up. From these few models that we have on here, that would be the last target up we have. I can, of course, always come up with new ones, and depending upon how the market trades, this again can reset and come up with higher propulsion levels. But as of right now, I would say that this area we're in, 380 up to almost 400, is a place that, and I suspect we will make our way up there over time, is going to be an area that the market's going to have some difficulty in. So that's my take on the Qs, which means probably if you buy something now, just realize that you're on all-time highs, which we've been God knows how many times this year. And I know the S&P, I think, has made its 53rd all-time high of the year yesterday. So you can't say that buying all-time highs is necessarily a problem. Count-wise here, we've exceeded the 9 count. So we kind of went sideways for a month, and we started another leg higher. Look, the market looks good. There's no two ways about it. Generally, what I've been telling clients is that if you want to hedge, I would generally use the weekly conversion line and the weekly baseline here, the magenta and orange colored lines, as the two strikes I would use in a put spread, meaning I'd buy the higher price and sell the lower price against it, simply because that has been support, and we have not broken it the whole way up since the 2020 low. Once this went back into full bullish mode, we've never been beneath the baseline. We've tested it a couple times. So I would say, if you're looking to hedge, you put on a put spread as with these as strikes. That's the way I think of doing a hedge. I'm not looking for a huge decline in the market at any point, but certainly you could get a 5 to 10% for sure. And that's why I'm thinking in those terms. All right, let's take a look at the US 10-year. So here's the TNX chart. You know that we had the 913 bottom last year. We rallied into a 9 close to the high a little early, but 160, we went to 175. We've been trading off since, did a 9 down, which marked the low, and kind of a pretty sideways since. This yellow box is the Fibonacci box. I can certainly extend it farther in time, but this is where I'm looking for bond yields to make their ultimate bottom off of these lows and the subsequent high. So anywhere from I think this is 124 down to about 92 basis points is where I expect the low. And so far, that's what we do have. Now, clearly, yields are having trouble getting back above 140 or so. And we can watch how they react against this broken green colored old uptrend line. So when we rally, if we do, look for something near 147 to potentially be resistance. And you're really going to have to get above this. Well, it happens to be green also, this hyphenated horizontal green line at 147 or 14.7 in TNX terms to really create a new leg higher. So that's bonds for now. I don't think we go back I can't say ever, but 90 bips is the lowest I could possibly see this going. And I don't think we're going there. So, and if we do, I'd be selling out of every last bond I had. All right, let's also take a look at, before we get into the individual stock names, let's look at that WFH. So this is, I can't even look at the weekly chart because there's just not enough history. So here's the daily chart. This started basically the first week of January this year. And just notice, even in a brand new ETF, how the market often turns on these DeMark levels. Set up 9 high short term, pulls back. 9 pulls back significantly into new lows. 9 high didn't do anything here. 9 bottom. This 9 high led to the 13. So every time you do a 9, you have the chance to do a 13 in the same direction if the market keeps going that way. In this case, for instance, this 9 peaked the market and we traded beneath the TDST line that started the 9 up. In other words, the lowest true low in the 9 up. Once you trade beneath it, it would cancel any chances to look for a continuation from the 9, and we sold off. This 9 up led to this 13, the high of the move. This 9 up, which it did as it was building towards this 13, this 9 up gave you this 13. Side by side 13s, just a tad above what had been the high. Fake new highs here. Market pulls back, market pulls back. This one pulls back into a 9 down. That's the bottom. Now we clearly break out through these highs. We're on a 7 up, which means that if we pull back, you should find support here now towards what were these old triple highs. So in the mid to upper 70s, but not as high as 78. So let's call it the mid 70s should be support at this point. And if it's a good breakout, you should not get, certainly beneath this bar here, but even beneath the, let's say the close, you should not really get beneath 74 3/4. So work from home names, at least from those names that this particular ETF uses in its compilation, are collectively breaking out to the upside. So that's a good thing for those names. Now let's just take a look at the names that we had. We'll start with Zoom. I'm pretty sure I put this out. Here it is. So here's the weekly Zoom chart. Very interesting. Zoom is actually having, I see on CNBC, its second worst day ever as of right now as we record late morning on Tuesday the 31st. The weekly count shows an 8 down on a setup. There is no 200-week moving average because Zoom hasn't been around long enough. It first started trading in 2019. We don't have 200 weeks yet, but this moving average here in purple is a 100-week moving average. That at least we can do. So next week, we're going to have a setup 9 down. We're likely going to be somewhere near the prior lows that we saw. So in May, we got down to 273. The Fibonacci 62% retracement from all-time lows to all-time highs is down to 262. So you know that in this area, down to about 245 is where the real support is, because there's this dotted red line is the TDST line from this last 9 count up. It's the lowest low, or in this case, lowest true low. So it's the close of the prior week. And that's at 245-ish. So probably between 245 and 260 is the place that if you want to buy Zoom on a pullback, is the place to do it. So we're getting closer. I mean, we're at 293. We're not quite there yet. But given that opportunity, that at least you kind of know where your risk is on this. And it's down to about 245. Okay, next, let's take a look at CrowdStrike. CrowdStrike has been trading straight up, also doesn't have a heck of a lot of history, but it's still maintaining its uptrend line perfectly to that springtime sell-off. Double 13s here, those come off of these, you have 3 9s, so here's 1, 2, 3 13s. We've gone sideways for, I don't know, 6, 7 weeks. We're pushing higher here now. Notice that the pullback stopped at the propulsion exhaustion level, these red triangles, and turned around. Down close followed by up close above the level. Let's see, open higher this week. So well, to me here, the next break, if getting above 293-ish or so sets up for a move that can get all the way up to 388 over time. So that would be the larger upside target for crowd. And these 13s are still active unless we properly get above 293 or so. And that can, even if it happened this week, that would not be, it would not properly break above this level to nullify that still as being the risk level against those 13s. Okay, what do we have? Dropbox, DBX. Okay, so there's all-time highs up there. So 13 whole rounding bottom into a 9 up here. Targets, interestingly, the TDST line, this dotted blue line, has nothing to do with these green triangles. They're totally calculated differently. They happen to show up in the same place, just about at $35. That's a good place to do some selling here. If you're long or selling calls, etc. Yep. And I mean, if you look to buy a pullback, I don't know if we'll see it, but mid-20s, anywhere from 26 to 25 looks like the place to be a buyer. Here's Atlassian, ticker's Team. This has been flying. Obviously, a very welcome stay-at-home name. The 100-week moving average. This has been able to stay above. Notice the transition here from highs. We break it out, pulls back to the same place it broke out from, and has moved up again. I mean, this name is just flying. I don't even have a target on this. I'd have to do more work, but it's not going to come from these. The models I have running right now on a pullback, looks like it broke out from these highs here. So anywhere from 276 to about 286 is where there's support. Google. We're using the class A's, obviously flying. Very few of these 13s. The last time, let's see, probably the last one that got you'd actually take on the trade was this one back here, went sideways for weeks, and then you would have got stopped out. And these 13s never got confirmed. So this is just a rip-roaring name that is going ballistic. And again, nothing on these models. I need to do larger studies to come up with something. So I don't have much for you here, unfortunately, other than it just keeps going and going. Where would I be? Have a little concern if it broke. I would say probably this 9's low. So 2470. That's a long ways down percentage wise, so it's way over 10%. Don't have much to add here. Sorry. Adobe. Not as quite as bullish as Google was, but similar look, held above the 100-week moving average. The slope of this starts really, you can see, is starting to pick up. Angle here because of the severity of the up move. Target on the upside is near 702. It's currently 664. On the downside, a qualified and confirmed Friday close beneath 635. Target 602 and 536. Let's see if I put up the cloud, what we get. Anything? Okay. So this did pull back to the cloud. So this has had several pullbacks to the cloud over time. Notice how far away from the cloud we are. That gives you a hint of just how overbought it is, but it doesn't mean just because it's overbought, it can't stay overbought. So I would look at, if you want selling calls or something, if you long the stock, this has been something you've had for a heck of a long time. If you don't mind taking, profits or possibly taking out of some of your position, you sell some 702, so let's say 705 or 700 strikes. Some of the calls or something, and if they take it away from you, they do, but otherwise you're pocketing some money by selling covered calls. Nutanix, NTNX. I know this is something that I had spoken about. Just let me see if it was the daily. Yeah, I knew the daily chart had a 13 last week into the bottom of the cloud. I like the way this is acting, at least short term. There is, a 13 and 9 peak here. We pulled back to the baseline. We're back above the conversion line. I'd say it's pretty good against the double bottom here of 32 or so. And then look, upside targets are 40 and then the upper 40s. And that's probably what I'd play for. Big longer term, you've got targets all the way up here near 62. DocuSign, DOCU. Testing all-time highs that we made just a month ago. Notice here you go sideways, comes to the cloud, actually goes all the way to the bottom of the cloud, bottom's right there, and then rips for a whole new leg up. You should find support. So here, if we do, let's say that trend line breaks, so something in this area here too, you'll see it's north of the baseline, anywhere from 260 to 248 or so is support on a pullback. Otherwise, upside, we got nothing till 375. And that's the risk level on those 13s there, up at 375. Fortinet, FTNT, ripping to climbing that clouds conversion line. Same type of thing. If you ever have a name like this and you're concerned and you want to put it on a hedge, you buy the conversion line and you buy a put and you sell the baseline put against it to reduce the cost of the put, and it reduces potential profit of the put if this were to collapse. But the way this is trading, I would not expect that to happen. Worst case scenario is you probably pull back to the baseline at some point. Right now, you can't even break the conversion line. Twilio. Now, this is interesting in the sense that it made a 13 exhaustion level beneath the high of that 13 count. So you see this has been going sideways and pulled back from it. We still have some support from the cloud, I'd say above 222-ish. Where's that 322-ish? This is still okay. You're probably going to see some more congestion in here. So it's not dead money, but I would suspect that we'll still see some congestion here. Upside target 400, and then a bunch of them between where new highs between 450 and about 478. What do we have next? Chegg, CHGG. Similar look. This one has 13.9 right near the highs, pulls back to the cloud, then climbs the cloud, comes back in here. This one's tough, not as healthy a looking chart in general. I'm not sure here. I mean, there is a little sense of a trend line. Let me see. Yeah, I mean, there's something along these lines here. I don't know. I'd say if it pulls back, you want to see the 100-week moving average hold, but in here, I don't see much at all. And we'll do one more. Let's do Netflix, probably, because more people listing would have a possibility for a chance of owning that than anything else. So here, we've been sideways for a year. Huge underperformer this whole year, but the important thing here is take a look. There's a straight line here that held as support on any of these pullbacks. We are, let's see, get a proper close above 563 and change on Friday of this week. Well, let's see, last week was an up week. Oh, so it's not going to be qualified anyway. But if this thing breaks out to the upside, look for 627 to 650 as first target, and then way up at 819 over time if this thing gets a whole nother leg higher. On the downside, wouldn't want to see this come out through the bottom of the cloud. And that's probably it. That's all we have time for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.